In the beginning, I'm going to go ahead and share a little bit for those in the audience that may be joining us for the first time today and those that are already with us to highlight some of the updates that we have here at IAMS and kind of go through a little more about who we are. First concept here is new producer builders. When you come on board with us as an agency and with our service level guarantee, we also recognize that you're coming on board with a new agency, and we'd like to reward you for taking action on your part and partnering with us through that first application, through your first applications, actually in the first 180 days while you're with us here at IAMS. So in those first 180 days, we've got different levels of production on the screen. These are set up for annuity premium. It's about 0.1% on that for target premium, and both count for life insurance. So today, if you have a question about the new producer builders program, how to get access to it, or you want simply a copy of the sheet here that we have up on the screen, please let your primary contact at IAMS know, or myself, Justin Ford, be happy to get that out to you. But here's how it works. In your first 180 days, we have different levels for $100,000 in indexed premium for annuities and fixed premium for annuities. For that, a level of production submitted and paid through us in 180 days, or submitted rather, we're going to go ahead and offer you give you $750 in cash, an iPad, or 1,500 piece postcard mailing as an example, or our complete corporate identity package, which includes pre-formatted emails and a marketing analysis for your practice. For $250,000, we've got upping the ante on that, $1,500 or $2,000 in marketing reimbursement. So if you're coming on board with an existing marketing or expense that drives clients your way, through simple receipts, we can cover the cost of that by hitting the $250 level, all the way up to $1 million during your first 180 days with us, where we really start getting into some ability to take a look at covering your dinner workshop or your educational-based workshop event, preset appointment programs, and more. So if you have questions about the new producer builder program, don't be shy. Be happy to help. And thank you for joining if you are new with us. As you come on board with us, we're going to continue that. For those of you in the room that are with IAMS, maybe aware already of the marketing reimbursement program that we have here set up. $100 marketing reimbursement per $100,000 of indexed annuity premium, $200 per $100,000 of single premium life premium here, and $200 per $10,000 of target premium is your ongoing marketing reimbursement program. Again, ask your marketer about that. We're kicking off the year with our kickoff. We've been speaking with our advisors about, many of you called in with excitement. We love to hear that. We're excited about kicking the new year off. You're talking about your practice and increasing what you're looking to accomplish this year, or adding something new, looking for a way to better partner together. This would be one area that we can do so. So ask about your marketing reimbursement account, and appreciate you coming on board. If you are a referral, we also have a referred producer program, third way to make money with IAMS, in addition to what you get from the carrier and the support you get from IAMS. We've got your referred producer program. So we're going to pay you in a couple ways on that one. When the new licensed agent you referred gets licensed with IAMS, just for contracting, we're going to send you a one-time $50 bonus for that advisor, that agent. And then the second one, we're going to pay you thousands over time. So anytime your business, or your referral rather, writes additional business without it coming out of their pocket, without you being in a hierarchy, for the life of their business with IAMS, we're going to pay you out a percentage of their business as well, not from their pocket. Give them the new producer program, and that's an appreciation for referring people to IAMS. So you can see the numbers here. If you have interest, please let us know. If you have someone that would be a fit to benefit from our service, you like what you're seeing, and they're like you, because we like to work with you, please, by all means, mention that name to your primary director here at IAMS, or myself, Justin Ford, and we'll take care of them from there and get you paid on top of it. Speaking of happy with us, got to give a shout out here for our new business and back office team here and support, everything from contracting to annuity new business. I know that team right now is a little difficult to get a hold of industry-wide. They're working with the insurance carriers like a shield and a knight in armor to fight through the delays in some of the insurance carriers' processing time, licensing. We've all, I'm sure, been in the middle of the delay. Our team here is constantly following up on cases, and I've got to really say I appreciate the business or the work that they do, and I appreciate your patience out there as we are going through an industry kind of pop up, if you will, we've seen before. Saw the same concept back in 2008 when people fled to safety. And again, we will get through this, but I'm happier than I've ever been with the staff here at IAMS and processing my advisor's business and as much as they can do with those carriers, and appreciate your due diligence on your side. But services are number one, and we're going to be there for you during this time. Accessing our website, we've got some new updates here on our website, tools that you may not be aware of, you may have just not had to use. Everything from calculators like a 72T calculator, simple savings calculator showing additional deposits, calculator comparing the difference between simple and compound interest, all the way down to concise one-page documents that will help your client better understand a concept or a topic that you're looking at that can be customized with your practice name. That's all available underneath the sales resources section of our website. If you were unaware of that or you'd like to know more, again, talk to your primary director. We'd be happy to kind of give you a little orientation, point out some items, or answer questions on our website. Easy to register today. If you're licensed with IAMS, all you have to do is go to the site, act like you're going to log in, and hit register account. And it's going to ask for your email information and set your password. Give us about 24 hours or less. That can be clicked on for you and go from there. You can also quote term insurance as well as guaranteed universal life products like guaranteed index universal life with living benefits. Those can all be quoted. Company the best from the worst price, multiple states, multiple clients, multiple term periods, all from our website as well. In addition to that, when it comes to annuities, you have access to the tool that myself and my team here use as we're evaluating everything from a top income product like what we're going to be talking about today. In addition to that, when we're evaluating companies that have stepped out there and increased some of their fixed and multi-year guaranteed rates like the 4-year MIGA that Jake's going to be talking about today, all these can be accessible via our website by looking at the annuity section, annuity rate watch, and in addition to that, if you have a case, we'd be happy to help you with it. But if you're doing some product research on your own or just need some specifics on a product, I urge you to take a look at that on the site. Forms online, any form, new business, in-service form. If it's not out there, give us a call. We can get it to you, but you do have access to downloading free withdrawal forms, starting an income rider benefit form, transfer forms, et cetera, from multiple companies. Industry links, topic, news, conversation, discussions for you and your client, keeping up to pace, as well as current annuity news specifically, and a guide for long-term care insurance, whether that be asset-based, annuity, or life, or traditional standalone long-term care. The little that is left out there, we do have access to that on our website too, and single premium life. So take a look. Those resources are updated and ready to go out there. When you are, in addition to that, you can take your business applications through Firelight as well as IGO, which we use for the life insurance side of the business primarily. And you'll be able to see that and multiple companies coming on board as we speak with Firelight here. Don't know how updated the list is here, but I've only can think of about 2 or 3 that are not currently on Firelight or use their own. And those that use their own, like Aspida, you can access that information through working with us, and those work well on their platform as well. So electronic applications are in. Take a look. Register for Firelight today. IGO, you do not have to. You have access to it through our site as a licensed agent for life insurance applications, but you'll want to register, talk to your primary connection here about getting registered or myself for Firelight if you haven't used that yet. Turnkey Solutions, a creative marketing team. Essentially, IAMS, as many of you may be aware, has a fully functional in-house advertising agency, everything from professional digital media specialists all the way through graphic designers and those who helped set up this event today with us. That team is on our payroll, and we do that for a reason. A lot of advertising firms that may be an outside consultant agency, many of them own your material. Something that to note If you go to a local advertising team, you look through your contract after cutting the check for $1,600 or what have you to do the work. If you're not a customer of theirs ongoingly, or they decide to offer your same approach to another agent who comes into the area, many times you don't own that material. They can rebrand it with your name. It's not something that we do here. You own the material. Our staff also works directly with financial professionals in the retirement income and life insurance industry, annuity industry with us. So they know what's going down and they know how to get it to you without that. We'd love to be able to offer some solutions with you as we work on writing business together. And the goal there is obviously the more awareness your practice gets, the more people you get to see, the more business we have to work together. And it's a wonderful world. Speaking of working together with a client, we do have a fully functional corporate RIA, IAMS Wealth Management. If you're looking at building revenue, retaining clients, building additional relationships, or just simply getting away from the compliance headache of being a registered investment advisor out there on your own and want to join a established RIA, where you're looking for a place that'll treat your business more insurance friendly. Take a look at the annuities and the complete wealth financial for the client. We can do that here at IAMS. Let us know that if you have interest, or if you have interest in taking your 65, we'll help you from the book, cracking the first Kaplan books, all the way through opening up starting your U10 and getting you on board as well. We've got our company trips here that we're going to be updating and as we go forward. So at this point, I'd like to switch over the presentation to our primary speaker today, Beth Ricklefs, and we can get our presentation started. I appreciate you attending, and I'll be back to you here shortly. Beth, are you ready to go? Okay, I'm going to hand it over to Beth here, and we will get rolling.
Thank you. Sorry, guys, I'm not sure what the problem is here. I hope that you can see my screen here. I wanted to give just a brief overview or a background of how long-term care insurance came about. Of course, there's been nursing homes for many years, but kind of the road or the pathway to long-term care insurance started in 1935 with the Social Security Act, or the Old Age Assistance Program. And what that did is it made federal money available to assist poor seniors with health care as well as nursing home care. In the 1950s, there were amendments that happened to the Social Security Act, and what that said is that payments had to go directly to a nursing home facility and not to a beneficiary. That kind of cut out the ability for home health care, and so that created quite an influx of nursing home facilities at that point. In 1965, that Social Security Act was amended with Medicare and Medicaid. And then, of course, Medicare was designed to focus more on acute care, not long-term care. And then Medicaid did require that long-term coverage be available, but it had to be nursing home. It could not be home health care, assisted living, or anything like that. And so it forced people that if they needed care, they'd have to spend down all the way to get to Medicaid status. And then this caused a great influx in nursing home facilities. That was kind of the tipping point of the insurance companies getting involved with long-term care, because people did want the access to have the ability to stay in their homes, use assisted living, had better ways to pay for nursing home care if they needed it. So the long-term care insurance companies came out mainly in the 70s. Without the ability to have something to help with insurance, many people would not be able to pay out of pocket to afford home health or assisted living to avoid the spend down of Medicaid. So in the 1970s, that's when we started to see lots of different options that started to pop up. And in the 80s, it became more popular. And by the 90s, very common for a senior to have long-term care insurance. And at the time, they were able to do really quite Cadillac policies where we had inflation, we had good daily benefits, we could do limited pay, so somebody would know in 10 years they could have a paid up policy with long-term care, and everything was great. And if you fast forward to the 2000s, I started in the business in 2002 for a marketing organization that was primarily an annuity shop, but they were expanding into life insurance and long-term care. And when they were deciding what marketing team I was going to be on, I really wanted to be on the long-term care team because it seemed like it was going to be really exciting. There were lots of different carriers on the market, and that was going to be a really booming area of business that we could expand on with long-term care. In that early 2000s, legislation got involved to encourage people also to buy long-term care to protect their assets. You may have heard of the partnership program, and the National Association of Insurance Commissioners came together and put together a plan to present to legislation in all 50 states that encouraged people to buy long-term care if they bought a qualified long-term care with a specific daily or monthly benefit with inflation, whatever that bucket of funds was. Let's say it was $300,000. If they went into a long-term care situation, they would protect their assets dollar for dollar for whatever was spent out of that long-term care policy. And that was in hopes that people would do the right thing, and instead of planning on spending down a Medicaid, that they would insure themselves, ideally that would help out the states not have to have money or not as much money to pay for long-term care costs if somebody was in a Medicaid situation. And then we get a little bit further, and then all of a sudden the bottom kind of falls out. And what happened was insurance companies did not have an anticipation of how many people would actually go on claim, and how many people, and also how the health care would rise. So it was a double whammy. We have lots of people going on claim using their long-term care policies, and then you've got rising health care coming up. So then the long-term care companies started to get in trouble. And what we saw initially is that the long-term care company said, we're not going to raise costs on our current blocks of business. We'll just continue to redo the policy and have repricing on the new policies, and we'll try to manage risk that way. Eventually, that did not work either, and so you did see prices increase on people's long-term care. Some of them couldn't afford it, so we started offering them to cut back benefits, so they might change it from a short pay to a long pay, to changing inflation options, daily benefit, monthly benefits, and things to get it back into range where people could afford it. And then new policies that were coming out on the market were having limited benefits. We didn't see lifetime benefit anymore. We didn't see shorter pays and things like that. So then life insurance gets involved here, and life insurance gets involved first with offering long-term care or chronic illness acceleration riders on traditional life insurance plans, and usually those can accelerate at a 2 or 4% rate. And then early 2000s, we had MoneyGuard, so a merger of asset-based long-term care comes into play, offering single premium options to give a death benefit if someone dies, long-term care benefit if they need it, and return a premium at the time if they change their minds. And of course, those are benefits that have all been altered with the rising costs too. So that gives you just a background of where we are with long-term care. So we still have the options of traditional long-term care, but with the rising costs and the claims exposure, a lot of long-term care companies moved right out of the market. They don't want anything to do with it. They sold off their blocks of business, and now we just have a few carriers out there that actually specialize in traditional long-term care. So more and more agents and advisors are having to utilize life insurance or annuity options to mitigate this risk. So I'm just going to go through some of the definitions of what we've got available for long-term care, and then I'll hand it back to Justin to talk about the annuity options. So the basic definition for long-term care or even chronic illness is initially you have to not be able to perform 2 out of 6 ADLs. And so those, of course, are bathing, dressing, toileting, transferring, incontinence, and eating, or if you have a cognitive impairment. The big difference between whether it's triggered for long-term care or chronic illness is they both need to be at least over a 90-day period, and long-term care does not have to be permanent. It just has to be over a 90-day period. Sometimes in a long-term care situation, they do recover from that. Maybe they have restoration of benefits and so forth. Chronic illness is going to be determined that it needs to be permanent in most cases when we're looking at a chronic illness. And then you have a few carriers that offer chronic illness, and that's going to help us for our acute or short-term illnesses that happen, such as heart attack, stroke, kidney failure, Alzheimer's, and coronary bypass. So basic overview, the long-term care and chronic illnesses are going to be meant for long-term care. Critical is just for the short term. So the estimate of those over age 65 that can expect to have some form of long-term care, whether it's in-home, assisted living, adult daycare, nursing home, is going to be 70%. And we've got a pretty large amount that's going to be out of pocket that can make a big dent in what somebody's retirement savings plan would be. So it's becoming more and more important to have some kind of risk management, and life insurance or annuities could be the way that you could provide that. So it is, less expensive if somebody can stay in their home, especially if they have a significant other or a spouse to do that, to help them out. And same with assisted living. Then you see quite a bit of a jump for just a semi-private room for nursing home. So then we've got our 2 options, standalone long-term care, and then we have the options for chronic or LTC riders. I would split the chronic and LTC riders in another category too, and that would be traditional life insurance policies that have a rider or a rider that's included on the life insurance policy. And then the other category that we have are asset-based solutions. So, of course, you've got your standalone policies that are either going to offer you a daily benefit or a monthly benefit. You're going to have an option of inflation on there. Your typical elimination period is going to be 90 days. And you can usually choose between a 2 and a 5-year benefit period on traditional long-term care policies. The hybrid policies would be, you have some that offer a chronic illness that's just included in their policy. Examples of that would be Allianz, North American, F&G. And we'll talk a little bit about how the acceleration works with those in a later slide. And then you have several insurance carriers that have allowed us to put on either a long-term care or a chronic illness rider. And those usually work as a 2 or 4% acceleration or an IRS per diem. So if you have a $100,000 face amount, you pick a 2% rider on that, then it's going to accelerate $2,000 a month for approximately 50 months. If you pick a 4% rider on $100,000, that's $4,000 a month for approximately 25 months, and the products usually have some small amount of residual death benefit left. So like we've already talked about, there aren't very many standalone long-term care policies to look at. So this is causing, life insurance to step into place to help offer and mitigate that risk. So You've got your long-term care rider that falls under 7702B and chronic 101G. Long-term care riders that fall under 7702, you do have to have a life, health, accident, and health license in order to write those. Chronic illness, you do not. They typically both will offer tax-free up to the per diem, which for both is $4,000. It could be taxable after that. Long-term care riders can be either reimbursement or they can be indemnity. Chronic illness almost always is indemnity. There are a couple of ways that a life insurance policy can accelerate for chronic illness. To me, lean method and the discount method are pretty similar. So the way I would, I'll give you an example of a carrier that we have. There, when you trigger 2 out of 6 ADLs, 90-day period that's expected to be permanent, then they will accelerate up to 24% of the death benefit per year for 4 years. And it is not a true 24% because you are not paying for the rider. So when you trigger it, they take it off the back end. And the way that works, all of the so if you trigger it and it's a $100,000 death benefit, that's $24,000 that would be subtracted from your death benefit. So the death benefit would now be $76,000, and then they're going to look at age and cash value and things like that and determine what the discounted rate may be. And as you get closer to mortality, the closer it becomes truer to that 24%. So a 70-year-old triggering benefits is going to be different than an 85-year-old. The 85-year-old is going to be closer to that true 24% in the example of that acceleration. Then you've got your dollar for dollar method, which I kind of alluded to ahead of time, and that's when you put the chronic illness rider on, and if you're accelerating at 2% on 100,000, then it's taking 2,000 from the death benefit each year for the next 50 months until we've spent down the death benefit. Of course, you can do 4%. Chronic illness riders often offer per diem limit too, so if you want the maximum amount out of it, you can do per diem. Long-term care, it pretty much works just like I said on the chronic illness, except that you do have to have your life, accident, and health, and it could be reimbursement versus indemnity, so each company is different on that. Other considerations is that not all long-term care or chronic illness riders offer waivers, so you may go on claim and still be responsible for premiums. So you always want to make sure that you take a look at that. I'm going to fast forward to the second slide. So here's some examples of who does offer a waiver. So North American Protective, if you add Symetra's Chronic Illness Plus, it will. But, you know, John Hancock has a rider that you can put on there, and they don't allow that. Back to this slide, you know, there's, you know, the main difference between chronic illness and LTC is the licensing requirement, whether it's going to be reimbursement or indemnity, and then whether or not you have to have the ailment be permanent versus it could have been temporary as long as it was over a 90-day period. So we do have these carriers that offer the rider. So we would put the rider on John Hancock, Protective, Nationwide. AIG has it, Prudential has it, Protective. There's quite a few carriers out there that do. Here's some of our more popular chronic illness riders that are added onto product. Our single premium products are going to be One America, which is a great product that offers a joint policy that can make benefits very attractive. Lincoln, Secure Care, there's quite I don't know, there's 2 or 3 more out there that we can take a look at. National Western, Baltimore Life, Sagicor. The difference between these 2 categories of single premium is the One America's the asset base. They're going to be geared less towards giving you death benefit and more towards giving you good long-term care benefits. The chronic illness riders are going to run a little bit better with death benefit and some, not as much benefit for the LTC. We went over this slide here, and that is what I know about the history of long-term care and the different options that we have on the life insurance side. So I'm going to pass this back to Justin, and then I'm going to have him do the polling questions.
Thank you, Beth. Appreciate it here. For a Monday, sometimes going old school and just switching a headset works. So as Beth was talking about with asset care with a life insurance underlying base, there are some times where the annuity solutions with long-term care leverage or long-term care structure may be a better fit. And the primary reason that you would leverage these annuities seems to be health. So when you've got an asset that you're looking at protecting, whether it be standalone long-term care asset-based with life insurance or an annuity, we're primarily protecting an asset. So if we have someone that is declined for health reasons, we now have a solution on the annuity side of the house that can be a guaranteed issue solution for long-term care. We also have solutions that will be what I will call a simplified issue option for long-term care, and that will carry, in many cases, a little stronger benefit. And it's typically a 5 or 6 question knockout question list that you will answer, but that the client just can't get in at all with those knockout questions as an example. Even if they had AFib as an example, any diabetes complications, we have a solution that is guaranteed issue. So there's 4 primary companies out there. But before we get into that, the type of long-term care, when we look at annuities, we've got 2 different types, if I were to put a category on it, one of which is a true leveraged benefit long-term care. So in other words, you're going to have an asset that is going to derive, once triggered, it's going to generate a monthly or daily benefit, much like a long-term care or asset-based life product. Typically, those will range up to 275% of your dollar amount, and then they calculate a payout, $7,000 a month or what have you. Then there are what we'll call wellness riders on income benefits. So American Equity is an example. These are commonly known to us as doublers. And what those will do is they will double the amount of income that you're receiving if you were to go on claim or trigger the 2 of 6 ADLs. And that will double your own money back to you. It's not necessarily leverage, but it is a good option, can be, if you're looking for accumulation income with a protection, if you need more liquidity for long-term care. But true long-term care leverage is primarily going to be with the following 4 companies. We're going to be looking at the Equitrust Bridge, which is a new product. That product, extremely excited about this one because it's the industry's first guaranteed issue long-term care solution. Based on an annuity, the underlying account will receive index credits, and the indexed annuity that frame that it's sitting on in the current interest rate environment has some strong cap rates for a product that will also offer long-term care. This can be issued for a little bit better long-term care coverage if an individual is healthy, but if they do have any issues or concerns health-wise, they're not denied coverage, and they will take a just slightly lower benefit for their long-term care. So that can be a good one. We'll talk about where to use this one here shortly. We also have Global Atlantic's 4Care product. That is a traditional underlying rate annuity, 2 to 4% rate of return. The long-term care leverage is true, and it's simplified issues. So there will be a knockout questionnaire in the agent guide for that particular product. And in addition to that, Guaranteed Income Life Insurance Company has a solution very similar in One America. One America has what they call the annuity care, Annuicare, And where One America is unique is you can actually apply for the larger benefit. As you can imagine, by having life insurance tied to the asset-based long-term care, you're going to have the ability, the insurer has the ability to many times offer a longer term long-term care solution because they know a little more about the health history, et cetera. And it's structured using and being able to leverage their lapse rates when it comes to life insurance. But you can actually apply or have a husband and wife apply, like Beth said. One America is a great solution for joint cases. And say one spouse doesn't get covered. There's a health issue, they're diabetic, something happens. One America will actually allow you to switch after underwriting and being declined to their annuity care product. So all in-house, which is very convenient, particularly when you have spouses. You don't have to muddle around that whole thing. So the One America product transitioned from life to annuity, and that product is they have an FIA version. However, the rates are not up. They're built for accumulation, and they have a traditional rate option as well. So something to note about these income rider products on annuities. Many of them, to get the tax benefits or to be able to pay out the benefits without impacting any type of tax, non-qualified assets are going to be needed. The qualified assets will primarily be one. We have a product where you can get a bonus on the qualified money if you're converting to pay in with One America if you're using the life version. But for the most part, the annuities have not tackled the qualified asset field yet. So this is non-qualified money on those. And who's a good identifier? Who can you identify that may be a fit? Anybody that has dormant existing annuities, always an option. In other words, client had an annuity set up. Maybe they're paying fees for an income benefit. Maybe they're not. They'd plan to transfer that wealth. It's out of surrender. Maybe an option to upgrade them to using something like the Equitrust Bridge product, to where the underlying assets can be, or the assets they're trying to transfer in the client's net worth or portfolio can be protected by long-term care, and then also have some growth if they don't use it for long-term care. Any health declines. Number two, any long-term care insurance policies or clients that have been declined that you're aware of would be another great place to go, because up until now we did not have a guaranteed issue type of solution for this type of care. And then also I see a lot of supplemental usage. So in other words, we may have a dormant annuity and they're wanting to supplement their current long-term care policy, not wanting to pay a large fee for their traditional. Maybe they can't be underwritten, but it's a supplement to what they already have in force by utilizing the annuity, Equitrust Bridge, For Care, Gillico's product, or One America. And so those would be two areas to take a look at primarily. And if you're looking for marketing material around those topics, we do have various case studies and marketing material for both life-based and annuity-based long-term care. And with that being said, before I do the polling questions, next steps on this, if you have a case or an interest or a question, let Beth or I know. You can email Beth, particularly if you've got a case, and we will do a joint effort to illustrate or design both products to show you the difference between the two, and be able to see the leverage so you can make the choice. If you've got someone that was automatically declined, feel free to reach out to me or Beth. But we'd be happy to help with your long-term care case needs on this, see what we can do to directly assist. My name is Justin Ford, Beth Ricklefs on the life insurance side. And without further ado, I'm going to go ahead and go into these polling questions here. And we'll start with our first one. So our first polling question, give you a little bit of time. If anybody does have interest in IAMS wealth management, now would be the time. Rather than calling in, we can definitely get a call reached out to you or information out to you. And this way we can reach out to you while you're doing your beginning week and get a contact, get Duncan on the phone with you, answer any questions you have. Even as basic questions as I've never been registered before, how does this whole process work? Or if you already are and you have questions on fees and et cetera and transfers, we can definitely help you there too. So going to go ahead and close this one out in a moment here. Appreciate your response, and we'll go on to the next one. Excellent. Thank you. And we'll go ahead and go to the next one. Do you have interest? And this would be the one if you would like more information as it relates to either marketing information about today's presentation, whether you want to market the everything from the Equitrust Bridge product, have case studies on when each one would be beneficial, or particularly if you have a case that you're looking for a design on. This would be an area where if you select more information, we will be right back to you promptly on the phone and gathering that information, or feel free to email us here at IAMS, and we can get you that information. Also on the products, each attendee today will receive base level information on the annuity products and some of the long-term care information that we have here. I appreciate that. And our final question for the day would be our annuity and life academies. So if you would have interest in visiting or doing, many times I get a question about face-to-face training with IAMS. We've had some ups and downs and some changes to this ever since 2020, but our academies are something that we're looking at getting additional dates on. If you have interest in upcoming dates for trainings in local areas or coming out to see us here at IAMS, please indicate that now, and we'll make sure you get on the list for that as well, as we have new dates coming up and going forward. So we appreciate your, and I'm sure Beth, we can't split the headset here. They don't have the double headset, but Beth and I both appreciate your attendance today. If you have any questions whatsoever as it relates to long-term care insurance, feel free to reach out to us, reach out to Beth, and I can get her anything we need if we have a decline, where we need to go into the annuities. So appreciate your time. Hope you have a phenomenal week, and we will talk to you soon. Thank you.